Here's what nobody told you when you started reading about investing. Being smart makes it worse, not better. Worse. My attorney would like me to clarify, up front, that everything you're about to hear is educational content, not financial advice. He reviewed this script, flagged 4 sentences, and billed me for 90 minutes. 3 of those sentences are still in here. Make of that what you will. Now, you've read the books. You understand compound interest. You know what a price-to-earnings ratio is. You've probably watched more market analysis in the last year than most people watch in a lifetime. And your portfolio is still underperforming. Not dramatically, not catastrophically, just quietly, persistently. Every year, just a little bit behind where it should be. And you can't figure out why, because you keep doing the things the books say to do. Here's what I want to tell you. It's not a knowledge problem. You already have the knowledge. There are 3 specific cognitive patterns that develop in high-information investors, and they work against you so quietly, so rationally, so convincingly, that most people never identify them. You just feel the results. A portfolio that fights you. Decisions that felt right at the time and look puzzling 12 months later. 3 patterns. And if you've been managing your own money for more than 2 years, you almost certainly have at least 2 of them running right now. Let me show you exactly how they work. I want to introduce you to someone. His name is Daniel, 41 years old, works in technology, earns well above the median income, and has been managing his own investment portfolio for 6 years. In those 6 years, Daniel has read 12 books on investing. He subscribes to 2 financial newsletters. He checks market data every morning before his coffee gets cold. He also underperformed the broader market by approximately 36 percentage points over those 6 years. Not because he ignored his portfolio, because he paid too much attention to it. Researchers at the University of California, Davis, tracked the trading behavior of over 66,000 individual households across a 6-year window. What they found was unambiguous. The more frequently people traded, the worse they performed. The top 20% of traders, the ones most actively engaged, most informed, most involved, underperformed the market by 6.5% per year on average. 6.5% per year. Run that forward 20 years with compounding. You're not looking at a small drag. You're looking at the difference between a comfortable retirement and a very uncomfortable one. And the critical detail. The heavy traders weren't the uninformed ones. They were the engaged ones. The people who were reading, tracking, analyzing. People who looked a lot like Daniel. Behavioral economists call what was happening to him the illusion of skill. When you accumulate a large amount of information about markets, your brain does something very natural. It builds a story. The story feels coherent. The story says, I understand this situation well enough to know when to act. So you act. You rotate out of a sector that looks overextended. You take profits on a position that's run far. You reduce exposure before a data release you're nervous about. Every decision has a reason. You always have a reason. The market, as a rule, does not respond to your reasons. Transaction costs accumulate. Tax events trigger at the worst moments. The bid-ask spread takes a small toll on every move. And the academic literature is extremely clear on where this ends up. More trading, less money. Now, if you've encountered this idea before, you might be thinking, fine, buy and hold. I know, everyone says this. And here is the first deadlock. Knowing this does not help, because the impulse that drives overtrading isn't coming from your analytical mind. It's coming from a system that evolved over 100,000 years to reward action in the face of uncertainty. In environments where your ancestors lived, when something felt threatening and ambiguous, the correct response was to move, adjust, do something. Sitting still cost lives. That same system is running inside you right now. Every time you watch a position drop 2% in a morning, your nervous system reads it as a threat signal. The pressure to respond is not a choice, it's automatic. Reading about this phenomenon does not turn the automatic response off. You can understand it completely, explain it to other people, teach it to your children, and still feel the exact same pressure the next time your portfolio drops. So if the standard advice, just stop trading so much, doesn't fix the underlying pattern, what does? I'm going to tell you. But not yet, because overtrading is only the first layer. The second pattern is quieter, and right now it is doing more damage to smart investors than almost anything else I can point to. After 2022, a notable shift happened in how individual investors allocated their portfolios. Equity positions in self-managed accounts declined significantly. Money moved toward cash, toward short-duration bonds, toward instruments that felt safe after a painful year in markets. This was understandable, expected, rational seeming. And then markets moved into one of their stronger recovery stretches in recent memory. A large number of informed, attentive, sophisticated investors missed most of it. They were positioned defensively, waiting for the situation to clarify, watching from the side. This is recency bias. And if overtrading is about acting too much, recency bias is about being unable to see past the last vivid thing that happened. Your brain has a feature called the availability heuristic. The events that occurred most recently, most vividly, with the most emotional charge attached to them, those events feel more real, more representative, more predictive of the future than older, more distant data does. In ordinary life, this is a reasonable shortcut. Recent experience is usually the most relevant current decisions. In investing, it produces a specific, repeatable pattern of disaster. Markets don't move in clean, continuing trends. They overshoot, revert, surprise, and confound the most recent expectations at precisely the moment when everyone has adjusted their behavior to expect those expectations to continue. And here is the particular problem for smart, high-information investors. You consume more data, more analysis, more news, more market commentary, which means you have a constant, high-volume supply of recent, vivid, emotionally charged material feeding the bias. You're not more immune to recency bias because you know more. You're more vulnerable to it because you have more recent information to be biased toward. Let me introduce you to Sarah. 38 years old, has an MBA, started with a portfolio of $82,000. She did her research going into 2022, repositioned defensively based on that research, and protected herself from most of the drawdown. She was correct. She had the right read. So when 2023 arrived and markets began recovering, Sarah waited. The same analytical framework that had protected her now told her to be cautious. She had fresh, detailed, vivid memories of everything that had gone wrong. The data was recent. The pain was recent. The lesson felt clear. She re-entered near the top of the recovery. She captured roughly a third of the upside she could have captured. Sarah is not a bad investor. Sarah is a very good investor, running a cognitive operating system that wasn't built for modern financial markets. Recency bias doesn't feel like bias. This is what makes it so pernicious. It feels like learning from experience. It feels like appropriate caution. It feels, in many ways, exactly like wisdom. Because in most domains of life, recent experience is a reliable teacher. Investing is one of the few areas where it systematically misleads. You can read about recency bias, recognize it in others, and still have it running in the background of your own allocation decisions, shaping your confidence, your timing, your sense of what's normal. The standard advice is to zoom out. Look at the long-term historical data. Don't let one bad year rewrite your entire model of how markets work. And here is the second deadlock. Looking at a chart showing 40 years of market history does not neutralize the emotional weight of lived recent experience. Your brain does not weigh evidence by a time horizon. It weights evidence by vividness and emotional charge. A decade of positive historical data sitting next to the memory of watching your portfolio fall 15% in 6 weeks is not a fair contest. The memory wins every time. So if understanding recency bias doesn't fix it, and looking at historical charts doesn't fix it, what does? I will tell you. But I need you to have the third piece first. Because the third trap is the one that locks both of the others in place. It's the engine that makes overtrading feel necessary and makes recency bias feel permanent. In 1979, 2 psychologists published a paper that quietly changed how the financial world thinks about decision-making. What they documented was this: losing a given sum of money is psychologically approximately twice as painful as gaining that same sum is pleasurable. Losing $1,000 feels roughly twice as bad as gaining $1,000 feels good. This is loss aversion. And it is not a personality quirk. It is a feature of human cognition so consistent, so deep, so universal that it holds across cultures, income levels, and, critically, across levels of financial sophistication. It holds for you. Here's why this matters for everything we've discussed. Loss aversion is the engine driving overtrading. When Daniel watches his position down 3%, the discomfort isn't proportional to the dollar amount. It's amplified. His brain is running approximately a 2-to-1 multiplier on the emotional pain. The only pressure relief available is action. Sell, reduce, exit, do something. The trade isn't coming from analysis. It's coming from a nervous system that has experienced a loss event and cannot sit with the discomfort. Loss aversion is also the mechanism that locks recency bias in place. When Sarah watches markets fall, those loss events get encoded with disproportionate emotional weight, not just because of the dollars involved, but because loss is felt at double the intensity of equivalent gain. Her caution in 2023 isn't purely rational. It's the nervous system holding on to a heavily weighted receipt. So you have a system. Overtrading generates more transactions. More transactions create more opportunities for loss events. Loss events are felt at double weight. That doubled emotional signal amplifies the response to market declines, which feeds recency bias. Recency bias informs the next round of allocation decisions. Those decisions generate more trades, round and round. The more information you have, the better your analytical mind gets at constructing logical-sounding justifications for each step in the cycle. You're never acting impulsively. You're always acting for a reason. The reasons just happen to be assembled by a brain that is running 3 interlocked biases in the background. This is why smart people keep losing money. Not because they don't know enough, because they're applying intelligence to a problem that isn't primarily an intelligence problem. It's a behavioral architecture problem. And architecture can be changed. 3 protocols: specific, researched, and designed to work above the level of the biases, rather than trying to reason against them in the moment. The first is what I think of as the 48-hour hold. When you feel the impulse to make a portfolio move, any move, you implement a mandatory 48-hour pause before executing. Not to do more research, not to seek out confirmation for the trade you've already decided to make. You write down the reason for the intended move, you close the screen, and you return to it in 2 days. The mechanism here is straightforward. The emotional urgency that drives reactive trading has a half-life. The anxiety, the discomfort, the sense that something must be done right now decreases significantly over 24 to 48 hours. The market, in most cases, is still there. A legitimate opportunity, if one existed, usually hasn't disappeared. What disappears is the pressure that was driving the decision. The critical implementation detail. This rule must be established in advance, in a calm moment, before the emotional pressure arrives. Rules set in tranquility govern behavior in anxiety. You cannot negotiate with your nervous system during a drawdown. You can set up a structure that operates in advance of it. The second protocol is the pre-mortem. Before making any significant portfolio change, you write a scenario in which the move turns out to be wrong. Not might be wrong, is definitively wrong. You're writing from 12 months in the future, explaining specifically what happened and why the decision failed. This technique works directly against recency bias, because it forces your brain to construct the opposite outcome with the same narrative vividness it's currently applying to recent events. You're not trying to override the availability heuristic. You're using it by deliberately generating an alternative vivid scenario that populates the other side of the decision. Research on this technique, originally developed in project risk management, shows it measurably reduces overconfidence in decision-makers, including sophisticated ones who believed they were already accounting for uncertainty. Same brain, same cognitive architecture, different input, different output. The third protocol addresses loss aversion specifically, and it's a reframe rather than a rule. Reclassify drawdowns as the cost of participation, not as performance failures. Markets are not machines that produce consistent positive returns every quarter. They are long-duration processes with inherent volatility. Drawdowns are not malfunctions. They are part of the expected operating conditions of the asset. When you mentally account for a 10 or 15% drawdown as the predictable cost of holding a long-term position, rather than as a loss that represents something going wrong, the emotional multiplier attached to it decreases. Not to zero. Loss aversion doesn't vanish, but the drawdown stops being processed as a signal that you need to act. It gets processed as confirmation that things are operating within the expected range. And that distinction between a malfunction requiring a response and an expected condition requiring patience is the difference between staying in a position and executing a reactive trade you'll regret in 6 months. Let me close where I opened. Daniel, the tech investor with 12 books, 6 years of diligent attention, and a portfolio that was quietly losing the race. He implemented the 48-hour hold as a firm rule before the next period of volatility arrived. He built a pre-mortem template, a single page, that he completes before any position change above a threshold he defined in advance. And he did a deliberate reclassification of every drawdown in his portfolio history, re-tagging each one from loss event to cost of participation. His trading frequency dropped by approximately 70% over the following year. Transaction costs dropped with it. The portfolio stopped fighting the market and started moving with it. He didn't become a different person. His brain still feels the pressure during drawdowns. He still has recency bias. Loss aversion is still running. But there's a structure now that operates above the impulses, instead of relying on willpower to fight them in real time. And here is what I want to leave you with. The books you read were not wrong. The information was not bad. The analysis you do is not worthless. The missing piece was never knowledge. Smart people keep losing money in the stock market for one reason above all others. They bring their considerable intelligence to bear on a problem that intelligence alone cannot solve. The biases don't care about your credentials. They don't care about your research. They run underneath all of it, in a part of the brain that evolved long before markets existed. The three patterns, overtrading, recency bias, loss aversion, form a system. The three protocols, the 48-hour hold, the pre-mortem, and the cost of participation reframe, are designed to work against that system structurally, not by making you smarter, by making the system work with your cognition instead of against it. My attorney, having reviewed the final version of this script, would like to note that the historical examples discussed here are for illustrative purposes only, and that nothing in this video constitutes financial advice or a recommendation to take any particular investment action. He charged me for that sentence. He also told me the numbers don't lie. I agreed. He billed me for that too. One question before you go, and I'm genuinely asking. Of these three patterns, overtrading, recency bias, loss aversion, which one do you recognize most clearly in your own decision-making? Leave it in the comments. The answer you give might tell you something more useful than anything I just said.